whether you're a seasoned investor or just starting out. Diversification, in essence, is the practice of spreading your investments across different asset classes, industries, and geographical regions. It's the perfect strategy to avoid the all eggs in one basket scenario. By diversifying, you're building a layer of protection against market volatility and opening up a world of potential returns. So, if you're ready to take your investment strategy to the next level, you're in the right place. Stay tuned to explore how diversification can help you achieve your financial goals. First off, what exactly does diversification mean? It's a term you've probably heard thrown around in investment circles. So let's demystify it. Diversification is like casting a wide net with your investments. It's the strategy of spreading your investments across a variety of asset classes, industries, and even geographical regions. The idea is to avoid being overly reliant on any single investment. Imagine having a dozen eggs. Would you carry them all in one basket? Probably not. If you drop that basket, there go all your eggs. Similarly, in investing, you wouldn't want to risk all your money on one stock or one sector. If that stock or sector goes south, you could lose a significant portion of your investment. So in essence, diversification is about spreading your risk. It's about not putting all your eggs in one basket. It's about creating a balanced portfolio that can weather the ups and downs of the market. Now, why is diversification crucial for your investment portfolio? Well, there are several key benefits to spreading your investments across a variety of asset classes, sectors, and regions. First and foremost, diversification is a powerful tool for risk mitigation. By not putting all your eggs in one basket, you can protect yourself from significant losses. Let's say you've invested solely in technology stocks, and suddenly the tech industry takes a downturn. If that's the case, your entire portfolio would suffer. However, if you've also invested in other sectors such as healthcare or manufacturing, those investments could potentially offset the losses from the tech industry. Secondly, diversification provides exposure to a wider range of investment opportunities. The global market is vast and dynamic, with numerous sectors and regions experiencing growth at different times. By diversifying, you're not limiting yourself to a single sector or region, but rather opening up your portfolio to the potential growth opportunities that exist across the market. Thirdly, diversification can lead to an increase in overall returns. While it's true that diversification can dilute potential gains from a single high-performing investment, the flip side is that it also limits the impact of any single underperforming investment. Over time, a diversified portfolio tends to provide more consistent returns and less volatility, which is beneficial for long-term investors. Lastly, diversification enhances the resilience of your portfolio. A well-diversified portfolio is like a sturdy ship that can weather storms and navigate choppy waters. No matter what the market throws at it, a diversified portfolio is designed to withstand volatility and keep you on track towards your financial goals. Diversification, therefore, reduces volatility and enhances the resilience of your portfolio. It's a strategic approach to investing that can help you navigate market ups and downs, seize a broad range of investment opportunities, and steadily grow your wealth over time. So when it comes to building a resilient investment portfolio, remember, don't put all your eggs in one basket. How can you effectively diversify your portfolio? When it comes to diversification, it's not about collecting as many different investments as you can. Instead, it's about thoughtful allocation across a variety of asset classes. This means spreading your investments across stocks, bonds, real estate, and other types of assets. This is known as asset allocation. Asset allocation plays a crucial role in determining the overall risk and potential returns of your portfolio. The right mix for you will depend on several factors, including your financial goals, risk tolerance, and investment timeline. For instance, if you have a high risk tolerance and a long investment timeline, you might lean towards a heavier allocation in stocks. On the other hand, if you're close to retirement and want to preserve your wealth, you might lean towards bonds and other less volatile assets. But diversification doesn't stop at asset allocation. It's also important to diversify within each asset class. This is often referred to as intra-asset class diversification. For example, within the category of stocks, you might want to invest in a mix of small-cap, mid-cap, and large-cap companies. You might also want to spread your investments across different sectors and industries, from technology and healthcare to financials and consumer goods. Geographical diversification is another key strategy. This involves spreading your investments across different countries and regions. By doing so, you can protect your portfolio from being too heavily impacted by any one country's economic downturn. In essence, diversification is about balance. It's about spreading your investments in a way that aligns with your financial goals and risk tolerance, without putting too much emphasis on any one area. It's about hedging your bets, so to speak, to ensure that you're not overly exposed to any one type of risk. Remember, the goal is to build a well-rounded, diversified portfolio. It's not about trying to hit a home run with every investment, but rather about consistent growth over time. By implementing these diversification strategies, you can better manage risk and increase the potential for steady long-term returns. And that's what smart investing is all about. While diversification is essential, it's not without its pitfalls. Now let's talk about some of the common mistakes to avoid when diversifying your portfolio. The first one we're going to discuss is over-diversification. Over-diversification occurs when you spread your investments so thin that you dilute potential returns. It's a bit like trying to butter a slice of toast with just a tiny smidgen of butter. The taste gets lost. In the same way, if you have too many investments, the impact of good-performing assets can be masked by the underperforming ones. So while it's crucial to diversify, ensure that you still have enough in each investment to make a difference. The second common mistake is neglecting to rebalance your portfolio regularly. Rebalancing is the process of realigning the weights of your portfolio's assets to maintain your desired level of risk and return. For example, if your portfolio's equity holdings have performed well over a period, they might now represent a higher percentage of your portfolio than you initially intended. This could expose you to more risk than you're comfortable with. Regular rebalancing helps to avoid this and keeps your portfolio in line with your investment strategy. Another pitfall to avoid is chasing performance or jumping on the latest investment trend. This is often driven by fear of missing out, but it can lead to poor diversification. Remember, past performance is not an indicator of future results, and trends can quickly reverse. Instead of trying to time the market, focus on building a well-diversified portfolio that aligns with your financial goals and risk tolerance. Lastly, don't overlook the importance of diversifying across different types of assets and sectors, but also across different countries and regions. This form of diversification, known as geographical diversification, can help to further spread risk as different markets can perform differently at various times. Avoid these mistakes to maximize the benefits of diversification. By being mindful of these pitfalls, you can ensure that your diversification strategy is effective, helping to safeguard your investments and bring you closer to your financial goals. Want to make the most of your diversified portfolio? Well, the first step is to conduct thorough research. Understand the asset classes, industries, and regions you're investing in. Knowledge is power when it comes to diversification. Next, it's crucial to regularly review your portfolio. The market is dynamic, and so should be your investments. Regular reviews will help you identify any necessary adjustments to maintain your desired level of diversification. And don't be shy to seek professional guidance. Investment advisors can provide valuable insights and help you navigate the often complex world of investing. Finally, remember that diversification is not a one-time event, but a long-term strategy. It requires discipline and patience. Don't be tempted to make drastic changes based on short-term market fluctuations. Stay disciplined and stick to your long-term investment strategy. This is the key to making the most of diversification and achieving your financial goals. So there you have it, the power of diversification in investment strategy. We've explored the ins and outs of this essential tool, from understanding what it means to diversify, to reaping its benefits, implementing strategies, avoiding common mistakes, and applying pro tips for effective diversification. Remember, by spreading your investments across a range of asset classes, industries, and regions, you're not only mitigating risk, but also opening up to a broader spectrum of opportunities. And while it's a powerful strategy, it's also important to stay vigilant against over-diversification and to keep a keen eye on your portfolio balance. If you found this dive into diversification enlightening, be sure to like this video, share it with your fellow investors, and subscribe to our channel for more insightful journeys into the world of personal finance and investment strategies. Thank you for watching, and until next time, happy investing, and I'll see you in the next video.